Hello everyone, thank you for attending this course. So in terms of equity investment, we have introduced 7 sustainable investing strategies for listed equity. Today we will continue our journey with private equity. Since green projects proposed by small companies or startups are largely financed by private equity, it would be beneficial to understand the investment process, investment life cycle, market situation, and so on. So let's move on to the agenda. This chapter has been divided into two parts. The first part consists of mainly definitions and terminologies, such as the meaning of private equity, the investment horizon, the investment life cycle. The second part will introduce a quantitative paper introducing the potential factors that driving private equity investment to go to the green side. First, what are private equity firms? Private equity firms buy stakes in private companies with the hope of making a profit by later selling those stakes for more than it was invested. Private equity firms usually use a buy low, grow fast, and sell high strategy, and they raise money from a variety of sources that will invest in private businesses. And they usually rely on a focused team of operating managers to run their portfolio companies, and constant monitoring and improving is important for them. And they make money from fees on the assets under management and from the increased value of the business they own. Here is the life cycle of a startup company. And startups usually first raise money from the so-called friends, family, and full FFF, those groups. And then when the company shows some early stage development, angel investors and some venture capital funds will step in. And if the business is really working great and entering the growth stage, private equity will take over and try to push the growth to the next level, which is usually an IPO. And finally, investors can cash out by selling stocks to the public. So, what's the difference between private equity and venture capital? In summary, private equity firms invest in companies that are in the growth stage of their life cycle, which is quite late already. And private equity firms generally want to see at least 3 years of profitability before investing. But on the contrary, friends, family, and fools, angel investors, and venture capitals will invest in startups in the early stage of their life. And these companies are often pre-profit or in their first few years of turning to a profit, so the risk is higher. And private equity firms prefer a lower risk, but also considerably higher growth rate. So private equity funds are formed by both limited partner and general partner. Limited partner are usually insurance companies, trusts, endowments, pension funds, and high net worth individuals and banks. So they are not involved in the day-to-day business. They provide the majority of the funding. So they provide 90% of the fund of the capital, and they got about 80% of preferred returns. They also get the majority of the returns. On the contrary, general partner has histories as bankers, accountants, portfolio managers. They source deals, manage transactions, and maintain communication with companies that the fund invested in. And they provide only 10% of the total capital, and they got 20% of the capital gain. So which means they take more responsibility, and they also got more returns. And finally, they also get like about 2% management fee. This graph shows the general structure of private equity funds, and this visualized knowledge on slide 6. For instance, funds capital makeup, we have 10% from general partner, 90% from limited partner. And from the profit distribution, we have 20% flows to the general partner, but 80% flows to the limited partner. And here is a graph about the PE private equity funds life cycle. So a PE fund usually needs 1 to 2 years to raise money, and then when raising money, they will simultaneously start purchasing stocks, companies, assets, and this process may last for 2 to 5 years. And after the deals has been closed and the long-term managing, monitoring, and improving phase starts, and depending on the grade duration or the lifetime of the funds, the fund may last for 3 to 7 or even more years. And finally, the fund will be liquidated and all the assets will be de-invested and profits and principal will be distributed. And finally, how big is private equity? Almost everyone has heard about private equity, but very few understand the size and scope of private equity firms. And the graph shows the top 25 private equity firms by their funds raised over the last 5 years. And raised in total a bit less than 800 billion US dollar. This is within 5 years. And America is the leading country in terms of private equity fundraising. And we can see some familiar faces like BlackRock Group. This is the biggest one. And finally, actually, all in all, private equity has a sizable market and is a very important financing sources for companies who are not able to get money from a bank or has already loaned too much money from the bank. And finally, we will cover some knowledge about private debts because they are part of the direct investment family like private equity and also venture capital. And private equity covers the lending of money to companies and individuals by entities other than banks. So they are not banks, they are financial firms and or funds. And since the financial crisis in 2008, big commercial banks has been reluctant to allocate resources to lend to small companies. And this actually facilitates development of private debt. Private debt funds specialize in lending activity and raises money from investors and lends that money to companies. It provides investors with exposure to more bond-like returns occurring from private debt as an asset class. So you can treat private debt as an asset class, and they does basically the same thing like bank. They borrow money from investors with one type of risk characteristic and lend money to investors with other types of risk characteristic. Apparently, they gather money from people who has low risk and then lend money to people who has high risk, and then they can earn the interest rate spread. And frequently, the loan is asset-backed, which makes it safer. And private debt funds do not seek to own companies. This is different from the private equity. They actually buy shares from the companies. And private debt funds can sometimes be open-ended, while private equity funds will often be closed-ended. And investors invest in private debt is increasing because of the low yield available for government bonds. And this is actually changing nowadays because inevitable increasing interest rate to counter the inflation problem. Maybe the landscape of private equity lending will change in the next 5 years. Now let's start with the paper analysis part. The selected paper named Think Global, Invest Responsible, Why the Private Equity Industry Goes Green is written by prefer and forget. And they actually designed a survey and multivariate regression analysis to investigate the fundamental characteristics that drive private equity funds to do sustainable investments. So the motivation of writing this paper, so this is based on the fast integration of the environmental, social, and governance issues by mainstream private equity investors, and this is basically driven by the fast development of SRI on public sectors, on public financial markets. So, which means those 7 sustainable investing strategies on listed companies. And different from the previous literature, this article sets out to analyze the private equity channel in order to show the characteristic and drivers of this movement in terms of private equity instead of the listed equities. The sample consists of 308 private equity firms in 2011, and they are all located in France. It is close to the whole French market and includes 278 out of the 280 members of the French Private Equity Association. And for the equity data, by going through the private equity firm's website, press release, and specialized media, the author collected many fundamental characteristic data such as firm age, number of funds it manages, and firm size, and also number of investors, and many others like if the firm has a UN PRI signatory. And finally, the ESG integration related data were gathered from a survey, and the response rate was 24%, which is already much higher than previous studies. And the detailed survey questions are documented in the appendix. If you are interested, you can have a look at them. The methodology of this paper is quite straightforward. To check the average distribution of fund characteristics such as the percentage of UNPRI signatory, the fund age, ownership structure, ESG performance, and so on, the author conducted descriptive statistics on public and survey data. Public data means those data gathered from websites, specialized media, and the survey data are generated from the survey. And we will go through one example in the results discussion parts. Then several probability regression are used to analyze the factors driving private equity firm implements responsible investment practices. And 3 public indicators of responsible investment are empirically investigated. So they are basically the dependent variable. So being a UNPRI signatory, managing a fund specialized on environmental social issues, and communicating on responsible investing on websites. So those 3 factors, the signatory, managing a fund specialized on such issues, and communicating those responsible information on website. And using those 3 alternative measures of responsible investing enables us to just check whether they have similar underlying drivers or not. The table on slide 15 displays that governance was mentioned by 66% responders, significantly exceeding environment 20% and social 53%. And this indicates that private equity firms are more likely to favor governance aspects within the ESG issues. And there are many other interesting findings you can observe from the descriptive statistic table. Please try to have a look at them by yourself. And the second part of the result comes from the multivariate regression. So from the upper table, we can see that the probability of being a UNPRI signatory increases by 0.058% for any additional employee. This can prove that socially responsible investing is more likely in large private equity firms in terms of workforce. So the more the employees, the better chance private equity firm will go green. And the lower table shows some other findings. The probability to manage such funds statistically significantly increase when firm is a venture capitalist. And more precisely, marginal effects reported in the lower table indicates that the probability of managing a green or social fund is 5.55% higher in venture capital funds. So this can prove that venture capitalists are more likely than other private equity investors to develop specialized green funds to open new markets, or they are more likely to do green funds, specialized green funds. Again, there are many other findings. Please check by yourself. And finally, here is a table summarize all the hypotheses accepted and rejected. Since this is a paper discussing the impact of fund characteristic on the decision of whether investing sustainably, and also included a vast amount of factors in their descriptive and regression analysis, and consequently many significant results were generated. And to gain a holistic view, you must compare those results with the hypothesis and the table results table, and then try to think about by yourself, and finally you will have a lot of findings, interesting findings from the paper. And this is the end of this chapter. Thank you so much for your attention, and see you next time.